Your screen is lying to you right now. February to 2026, 8:47 a.m., and that number glowing on your monitor, that $83.49, is not the price of silver. It is the price of your ignorance, your compliance, your willingness to believe that markets are real when they stopped being real the moment algorithms learned to hunt human fear. 6 days ago, your portfolio was whole. 6 days ago, you were watching silver climb past 121. And you felt something you had not felt in years: hope, safety, the belief that maybe, just maybe, you had finally figured it out. And then they took it from you. They ripped $26 off the price in minutes. That silent judgment, and you do not even know what hit you. You think it was the market. You think it was volatility. You think it was your fault for buying at the top. But I'm going to show you exactly what happened. I'm going to walk you through the crime scene. And when I am done, you will understand that what happened on January 30th was not a market correction. It was a calculated execution. The people who run the silver market, the banks that sit on the COMEX board, the hedge funds that move billions in seconds, they want you to think the crash was natural. They want you to believe in price discovery. They want you to trust the charts. I saw the candles. I watched the volume. I know what time the orders hit. And the fingerprints are everywhere. Look at your chart right now. That vertical drop from $101 to $85. $16 gone in 8 minutes. Your life savings cut by 15% while you were making coffee, while you were checking your phone, while you were living your life like a normal human being. And in those 8 minutes, 369,000 contracts traded on the COMEX. Do the math. That is 1.845 billion ounces of paper silver dumped onto the market. Billion, with a B. They traded more than 2 years of global production in a single afternoon session. While London was closed, while Shanghai was sleeping, while only New York could set the price. Calculated, I should not be telling you about the 97-second window. At 3:49 p.m., silver touched $74 row $3. And if you were leveraged, if you had bought on margin, if you had trusted the futures market, your broker did not ask your permission. The computer made the decision. Liquidate. Account balance, $247. You had $89,000 that morning. By 4 p.m., you had $247 and a text message from your wife asking if you saw what happened to silver. And you sat there. Wherever you were when the notification came through, your actual physical hand trembled as you tried to click refresh, tried to make the number change, tried to undo what could not be undone. The sweat started at your hairline. Cold sweat. The kind that comes with nausea. Your heart rate spiked to 130 beats per minute. And for exactly 97 seconds, while silver sat at $74, you experienced what they designed you to experience. Pure, unfiltered, animal terror. Because your brain, your primitive survival brain, does not know the difference between losing $90,000 in a trading account and being attacked by a predator. The cortisol response is identical. The fight or flight activation is the same. And in that moment, sitting in front of your screen, you were prey. And they were the hunter. Then it snapped back from $74 to $82 in 3 minutes. You watched it climb and you felt something worse than the initial drop. That if you had just held for 3 more minutes, if your margin had been slightly higher, you would still be in the trade. But you were not. This is not market dynamics, psychological warfare conducted through price charts. And your emotion, your fear, your panic was the ammunition they used against you. Let me show you the physical reality while your paper collapsed. While your screen showed $74, while your broker sold your position, while your hands shook and your heart raced, something else was happening in the real world. The Perth Mint in Australia, one of the most respected government mints on earth, the notice said they were pausing all wholesale orders for their 2026 kangaroo silver coin until February 23rd. Not because demand dropped, because demand was too high, because they had a backlog they could not clear, because the actual physical metal that your paper contract claimed to represent did not exist in the quantities the paper market said it did. Your contract said you owned 5,000 ounces of silver. The Royal Mint ran out of stock. Costco, the American big box store that sells toilet paper and televisions, implemented a 1 bar per customer limit on silver because people were showing up with trucks trying to buy silver at $95 and the stores had nothing to sell. Your screen said $95. Your dealer said $110 after premiums. Your screen said discount. The physical world said sold out. And somewhere, in a vault you will never see, in a meeting room you will never enter, the people who dumped 1.845 billion ounces of paper silver on January 30th are buying physical metal through over-the-counter deals that never show up on your chart. They crashed the paper price. They bought the physical metal. They used your fear to take your silver. And you helped them do it. China knows. Why? For the green energy economy they are building while the West argues about pronouns. China produces 4,000 tons of silver per year. And as of January 1st, that silver is not leaving China. Your screen does not show this, your broker does not mention it, your financial news does not cover it, but the largest manufacturing economy on earth just cut off silver exports. And the global deficit, which was already 215 million ounces in 2024, just became catastrophic. Your paper contract does not care. Your paper contract exists in a fantasy world where supply and demand are optional. But your physical metal, if you actually tried to buy it, lives in reality. And in reality, silver is disappearing. The Shanghai Gold Exchange reported withdrawals of 27.3 tons of silver in a single day last week. 27.3 tons flowing out of Chinese vaults into private hands, into central bank reserves, into places we cannot track. Your screen showed a crash. Shanghai showed a buying frenzy. Your broker liquidated your position at $74. The silence of a blown-up account is different than any other silence. It is not peaceful. It is not calm. It is the silence of a funeral. You refresh one more time even though you know nothing will change. The balance still says 247. The position still says closed. The date still says January 30th. And you realize that your entire thesis, everything you believed about silver, might still be correct. The fundamentals might still be bullish. The shortage might still be real. But you are no longer in the trade. You no longer have a position. You are watching from the sidelines with $247 while silver trades at $83 and climbs and you cannot participate. This is the torture they designed. Not just the financial loss, the psychological destruction of being right but being too early, of seeing your analysis confirmed but your account destroyed, of knowing that if you had just bought physical metal instead of paper contracts, if you had just paid the premium and held coins in your hand, you would still own silver right now. But you trusted the system. You trusted the leverage. Your wife does not understand. They see the news showing silver crashed and they say, see, good thing you got out. They think you sold at the top. They think you made a smart decision. They do not know that you were forcibly liquidated. They do not know that you did not choose to sell. They do not know that your position was closed by an algorithm while you were helpless to stop it. And you cannot explain it to them because you barely understand it yourself. How do you explain that the price crashed to $74 for 97 seconds just to trigger your stop loss and then recovered? How do you explain that mints are sold out while the price is crashing? How do you explain that lease rates hit 8% while the market is supposedly oversupplied? You cannot, because it does not make sense. Your contract, when you bought it, gave you the legal right to demand delivery of 5,000 ounces of physical silver. That is what a futures contract is, a promise, a guarantee that if you hold to expiration, if you put up the full cash value, they will deliver the metal. But here is the ugly truth. COMEX registered silver, the metal available for immediate delivery, sits at 265 million ounces right now. There are currently over 500,000 open silver contracts on the COMEX. 500,000 contracts, times 5,000 ounces per contract. That is 2.5 billion ounces of contractual claims on silver. But only 265 million ounces of actual metal in the registered vaults. That is a ratio of 9.4 to 1. For every ounce of real silver, there are 9.4 paper claims. Your contract is one of those claims. And if even 15% of contract holders demanded delivery, the system would collapse, the vaults would empty, the exchange would default, and your paper promise would be worth exactly what it always was, nothing. They are counting on you to settle in cash. They are counting on you to take your profit in dollars and walk away. They are counting on you never asking for the metal. And for 99% of traders, that is exactly what happens. But what if it does not? What if the Chinese central bank decides they want delivery? What if a sovereign wealth fund demands physical settlement? What if a major industrial user needs silver for manufacturing and cannot source it anywhere else? Then the game ends, the paper market breaks, and the price you see on your screen becomes irrelevant. Because the real price, the price that matters, is the price at which physical silver actually trades. And that price is not 83. That price is 95 to 110, depending on the product, depending on availability, depending on whether the dealer even has inventory. Your screen lies. The vault does not. Lease rates tell you everything. Silver lease rates hit 8% in January 2026. 8% annualized to borrow silver for 30 days. Think about what that means. Some institution, some bank, some refinery was so desperate for silver that they agreed to pay 8% per year just to get their hands on metal for 1 month. Normal lease rates are 0.3% to 0.5%. Someone promised to deliver silver they do not have. And they are willing to pay 8% to avoid default. Your screen showed a crash. The lease rate showed a crisis. Your broker liquidated your position. The vault showed scarcity, 2 signals, opposite messages, 1 lying. Let me tell you what happens next in your account. You have $247 left. You're watching silver trade at $83. And so you call your broker, you ask about opening a new position. Post-crash, COMEX raised the minimum margin to 25%. You have $247. You're locked out. You cannot get back in. Not with leverage. Your only option is to buy physical metal. They tell you the price is $83 spot, plus a $17 premium. That is $100 per ounce. For generic rounds, for American Eagles, it is $105. For anything recognizable, anything you can resell easily, it is $110 or more. And delivery is 8 to 12 weeks. Most do not. So you sit there with 247, knowing that the fundamentals were right, knowing that if you had just held on, just survived the liquidation, you would be profitable right now. But you did not. You could not. And now you are a spectator, watching your predictions come true without you. This is the psychological torture they perfected. Not just taking your money, taking your conviction, breaking your belief in your own analysis, making you doubt everything you thought you knew. You remember the pain of January 30th, and you stay on the sidelines, and they win twice. Once when they liquidated you, and again when they paralyzed you. Let me show you the commitment of traders' data, because this is where the crime is documented. The CFTC publishes a report every week showing who is long and who is short in the futures market. In the week before January 30th, large speculators held 90,000 net long contracts. 90,000. That is 450 million ounces. Retail traders, hedge funds, institutional longs, all betting on higher prices. The commercials, the big banks, the bullion dealers, held 105,000 net short contracts. 105,000. They were betting against you. They were positioned to profit from your destruction. When your position got liquidated, they covered their shorts at the bottom. They bought back 40,000 contracts in the week after the crash. 40,000 contracts. That is 200 million ounces. They sold high. They made billions. And your liquidation provided the liquidity they needed to close their positions. Your pain was their profit. And the system is designed this way. It is not a bug. It is a feature. Since 2021, the world has consumed more silver than it mined. Every single year. In 2021, the deficit was 194 million ounces. In 2022, it was 237 million ounces. In 2023, it was 184 million ounces. In 2024, it was 215 million ounces. In 2025, it was 260 million ounces. Added up, that is 1.09 billion ounces. 1 billion ounces more consumed than mined over 5 years. Where did that extra silver come from? It came from above ground stockpiles, from vaults, from inventory built up over decades. And those stockpiles are now almost empty. The LBMA vaults in London held 1.1 billion ounces in 2020. Today, they hold 155 million ounces. That is an 86% decline. 850 million ounces flowed out of London, east to China. Your paper contract does not care about this. Your screen does not show this data. But your physical metal, the metal you should have bought instead of trading futures, is becoming more scarce every single day. And the system is not designed to tell you this. The system is designed to keep you trading paper until the paper becomes worthless. Solar panels consumed 210 million ounces of silver in 2025. That is a 91% increase from 2020. And solar is accelerating. The International Energy Agency projects solar capacity will triple by 2030. That means silver demand from solar alone could hit 300 million ounces per year. Add in electronics at 250 million ounces. Add in electric vehicles at 50 million ounces and growing. Add in medical devices, semiconductors, 5G infrastructure, water purification. Total industrial demand is over 600 million ounces per year. That is 72% of total mine production. That leaves 235 million ounces for investment, jewelry, silverware, and everything else. But investment demand alone was over 300 million ounces in 2024. The math does not work. There's not enough silver. The system has survived by draining stockpiles. The stockpiles are empty. Your screen does not calculate this. Your broker does not warn you. But the mints shutting down, the vaults draining, the lease rates spiking, these are not coincidences. These are symptoms of a market that is breaking. And when it breaks completely, when the paper price can no longer suppress physical reality, your $247 will buy nothing. And the people holding physical metal will name their price. Let me tell you what I am watching right now, because this is how you know when the endgame starts. I am watching lease rates. If they stay above 7%, the crisis is not resolving. I am watching mint production. If the US Mint, the Perth Mint, the Royal Mint stay offline, the supply chain is broken. I am watching COMEX registered inventory. If it drops below 250 million ounces, we are approaching the point of no return. I am watching physical premiums. If they stay above $10 per ounce, retail demand is overwhelming supply. I am watching China. If export restrictions tighten, if central bank buying accelerates, the global market loses a major supplier. I am watching price action. F silver holds above $80 and breaks above $90. The bottom is confirmed. All of these indicators are flashing red right now, every single one. The data is screaming. But your screen shows $80 and tells you the correction is healthy. Your broker sends you an email about buying the dip. Your financial news shows analysts saying silver is overvalued. And you have $247 in your account and no position. So what do? You have three choices right now. Choice one, you walk away. You take your $247, you close your trading account, you tell yourself this was an expensive lesson, and you never touch silver again. You spend the rest of your life watching silver climb to $150, $200, $300, knowing you were right, but you did not survive. Knowing you understood the fundamentals, but you trusted the wrong market. And every time you see a headline about silver shortages or price spikes, you will feel a twist in your stomach, a reminder of what you lost. Choice two, you try to get back in with paper. You deposit more money, you open another futures position, you use leverage again because that is the only way to make back what you lost quickly. And when the next manipulation event comes, when they dump contracts again, when they trigger stops again, you get liquidated again. And the cycle repeats until you are completely broken, until your savings are gone and your conviction is shattered. Choice three, you buy physical metal. You take your $247 and whatever else you can scrape together and you buy coins. Real silver, metal you can hold, you pay the premium, you wait for delivery, you put it somewhere safe, and you stop trading. You stop watching the 1-minute candles. You stop checking your phone every hour. You hold. Because you understand that the paper market is a casino designed to take your money. But the physical market is real. When lease rates hit 15% and COMEX defaults, and the price gaps up 40% in a single day, you will have metal. To have security in a world that is becoming less stable every day. Silver at $121 was not the top. It was the warning. The system showed you what it could do. It showed you that it could take 40% off the price in 3 days. It showed you that it could liquidate your position without your consent. It showed you that it could drain the vaults while crashing the paper price. And it dared you to keep playing. It dared you to trust the screen. It dared you to believe that this time would be different. And if you take that dare, if you go back to futures, if you use leverage again, it will destroy you again. Because that is what it is designed to do. Your hand is still shaking. That fight or flight response, it carved a groove in your brain. And every time you think about buying silver, every time you see a chart, every time someone mentions the market, your body remembers. They use your fear against you. And the only way to break free is to change the game. Stop playing their game. Stop trading paper. You set your stop based on technical analysis and position sizing. And they knew exactly where it was. Not your specific stop, but the cluster. The area where thousands of retail stops were stacked. From 72 to 76 hours. And they drove the price through that zone like a knife through butter. Triggered every single one, liquidated every single account, and then let it bounce, because they did not need the price to stay at 74. They just needed it to touch 74 long enough to wipe you out. Mission accomplished. Now it is February 10th, 10 days later. A technical relief rally before the next leg down. They are telling you to sell. They are telling you the crash will continue. They are telling you that silver will test $70, maybe $60, and you have $247. And you are thinking, maybe they are right. Maybe I should wait. Maybe I should let it drop lower before I buy back in. And while you wait, while you hesitate, while you second guess, the Perth Mint is still not taking orders. The US Mint is still offline. The Royal Mint is still sold out. Lease rates are still at 7.5%. China is still restricting exports. The vaults are still draining. Nothing changed on the physical side. The only thing that changed was the paper price. And the paper price is designed to confuse you, to paralyze you, to keep you out of the market while they accumulate. While they buy the physical metal at discount prices using the fear they created. This is the final alpha, the ultimate truth, the thing they do not want you to understand. The paper market and the physical market are not the same thing. The paper market is a casino, a rigged game, a psychological warfare operation designed to extract wealth from retail traders and transfer it to institutions. The physical market is reality. It is supply and demand. It is vaults and mints and refineries and trucks and bars and coins. And right now, in February 2026, these two markets are completely disconnected. Your screen says $83. Your dealer says $100, plus out to 8 to 12 weeks. Your screen says correction. The vault says empty. Your screen says sell. The lease rate says panic. One of these is telling the truth. One of these is weaponized manipulation. And you have to decide which one you believe. Because if you believe the screen, you stay out. You wait for lower prices that may never come. You miss the recovery. You miss the squeeze. You miss the moment when the paper market breaks and the price explodes, and your 247 could have bought you a position that would have changed your life. But if you believe the vault, if you believe the fundamentals, if you understand that a 5-year deficit cannot be fixed by a 3-day paper crash, then you buy. Because the people who win this game are not the people with the best charts or the fastest algorithms or the most leverage. The people who win are the people holding metal when the music stops, when the paper burns, when the system admits it lied. And that moment is coming. Reality does not care about your screen. And when 300 million ounces of annual investment demand meets 235 million ounces of available supply, something breaks, and the people holding paper contracts will get cash settlements, but the people holding physical metal will get to name their price. Your choice.